Well, welcome everyone. Thank you for joining us. My name is Patty and I'm with Community Investment Corporation. And I'm here with Tom, Nova, and Haley to present regarding the Mortgage Credit Certificate Program, a tax credit program that's currently offered through Community Investment Corporation. The program has actually been around since 1991. I've been administering the program since 1995. And I've been working with Tom and his team for decades, I could say, at least a decade. So we've been administering the program for some time and kind of giving our age away there with the decades. So again, thank you for joining us. So the Mortgage Credit Certificate Program is a tax credit program that reduces homebuyers' tax liability and helps them save money. So essentially when we talk to the borrower, it's like, hey, you're in the process of purchasing a home. There's this tax credit program that's available, and currently it's available through the Pima County and the City of Tucson Industrial Development Authority. And what it does, it allows the buyer to take 40% of their interest as a tax credit, up to $2,000. So essentially, if a home buyer's loan amount is at least $125,000, their credit is going to be $2,000. That's what we're seeing pretty much for everyone. They're capping at the $2,000 limit. So we'll talk a little bit later where the tax credit is different from a deduction, because anyone that purchases a home can write off their interest as a deduction. Well, this is something in addition. So it's a great program to get out there to your home buyers, because right now you're helping them get into the home, but also once they're in their home, you're pretty much explaining this program to them that there's $2,000 every year for the life of their mortgage. So it says there the credits can be claimed year after year as long as the buyer lives in the home and has a mortgage. It says here also if the client doesn't have a tax liability. So we'll have this sometimes where maybe even right now where somebody may have lost their job and they are not going to be claiming taxes next year. Maybe they didn't earn enough to file taxes, or they decide they want to go back to school. And so they're not going to be filing tax returns. If whatever year they don't use the credit, they can actually carry it over and it rolls over for 3 years. So we've had that where somebody went back to school and they weren't filing tax returns and they rolled 3 years over. So they were rolling over $6,000. And then in the new year, they got their $2,000. So now they were sitting on an $8,000 credit. So that's something where people also, aren't really familiar with tax credit programs. So when we meet with the home buyers, we sit down with them and say, hey, bring me 3 years of your tax returns so that I can show you exactly where this is going to benefit you on your tax return. So here's an example of how it works. Okay, a reminder is the homebuyer needs to apply prior to closing. So when we're working with Tom or any mortgage company, as long as they submit the client's loan application, they've pretty much applied prior to closing. And so we don't slow down closing. There aren't classes they have to take, no home inspection, nothing like that. The buyer does everything with us, and we get all that done without slowing the buying process. That's something we don't want to get, because I know that's been an issue in the past where we're trying to, I know appraisals has been an issue right now. It's like we definitely want to keep the process going as smooth as possible. So we definitely stay out of that. Don't want to slow anything down. So here, how it works in this example, you have this loan amount of $125,000 at 4% interest. This particular person is going to pay $5,000 in just interest alone. So anyone that holds a mortgage, they can write off that interest, that $5,000 as a deduction. Okay, so we'll cover that coming up. What this credit does, it gives them 40% of their interest they're paying. So in this example, 40% of the $5,000 is a $2,000 tax credit. Okay. So here's an example on a tax return. This particular person, their wages are $37,000. And then on 8, you'll see there where we start talking about deductions. The standard deduction right now, you'll see here for this person is $12,000. So they, in the previous slide, had paid $5,000 in interest. So most people are going to do the standard deduction because they don't have enough to itemize. So this is where the program gets confusing sometimes, is because people think, or even tax preparers will say, we're not going to put your house on your tax returns. And they're usually referring to writing off the interest as a deduction. So this is where we try to explain to the home buyers is it's different from a deduction, because you probably will take the standard deduction, especially you'll see there, the married is 24,000, head of household is 18,000. So right now, after you take your deduction, in this example, now IRS is saying, okay, you made 37, we're gonna give you this deduction, so we can only tax you on the $26,000. So their IRS is going to say, we want from you $3,000. So that's what that 11 is. And on line 15, total, if they didn't have the credit, IRS is saying, okay, we want $3,000 from you. But on line 16, they had withheld from their pay stubs $4,300, which is why they got refunded on line 20, $1,300. Because most people are going to say, well, I get a refund anyway. And that's usually because they have extra taken out of their pay stubs. In this example, if you have that credit kick in, if this particular buyer on line 12, they're saying, okay, now you have this $2,000 credit, we're going to plug this credit in. And again, this is good every year for the life of their mortgage. So now, instead of wanting the $3,000 from them, they'll plug in the $2,000 credit. So now their liability, or what IRS wants from them, is $1,047. Again, they had $4,300 withheld. So where that's going to affect, it's going to increase their refund. So you'll see there, so now their refund has increased to $3,300 because this credit went in and reduced what IRS wanted from them. So as long as we're making wages, IRS is going to keep something. But people, don't understand until they actually sit down and look at a tax return and see, this is exactly where it kicks in. And this $2,000 will be there every year as long as you're paying interest on this mortgage. And in this example, it increased their refund from $1,300 to $3,300, which is a significant difference. So I know that's a quick explanation of how it works on a tax return. On this next page here, it'll show over the life of the mortgage, this particular person that had a $200,000 mortgage, throughout the 30 years, they're going to have $50,000 worth of credits. Okay, that $2,000 that they're seeing every year. And then, of course, it's going to go down a little bit towards the end of the year because they're not paying as much interest because they're paying down their principal. But mostly people are seeing about $50,000 on average. A little bit about how the program works. Where you can benefit from the program, the geography. It's available anywhere in Pima County in the city of Tucson. I see a question here. Are we going back to questions? Because I just saw one about refinance. I'll just answer it. I'll go ahead and answer it. I saw pop up a question about a refinance. If they do refinance, they actually just submit some new paperwork to us, just some closing paperwork. So they're regular forms that they're going to be signing at closing, and we issue them a new certificate to that refinance. So yes, refinancing is okay. Okay, so the geography, again, anywhere in Pima County and city of Tucson, and it's actually been extended. It's pretty much it's statewide. Maricopa is the only one that's kind of not playing fair right now, but we have gone into Chandler, things like that, but it is available statewide. Okay. There's some what they call target areas. Target areas are considered economically distressed. So they're out throughout town. If you happen to be purchased in a target area, you don't have to be a first-time home buyer. The income and purchase price limits are higher, and we'll show you that on the next slide. So there are some benefits to purchasing in a targeted area. So some samples at certain areas is like Prince and Stone, the city of South Tucson, that's all considered target. So there's on our website, if you're buying certain census tracts that are considered target, there's a few more benefits to buying in a target area, but pretty much all your areas are going to be in a non-target area. So the eligibility, there's mainly three things we're looking for. For sure, they have to be a first-time buyer or not owned in the last 3 years, or if they're buying in a target area, they do not have to be a first-time buyer, or if they're veterans, they do not have to be a first-time home buyer. And then we work with all home types. Okay, so manufactured, condos, we get this asked all the time. And then also all loans, okay, any loan, FHA, USDA, conventional FHA, and any lender. Okay, so we work with all mortgage companies. All right, Haley. And then, so the next thing we're looking at is your household income limits. So first-time buyers, one of our first things we're looking at. And then income limit, your non-target, again, is most your areas. For a family of 1 to 2, it's 67.9. For a family of 3 or more, is 78,000. So those are kind of generous. And then if you're buying in a target area, then the limits get higher. Okay, so family of 1 to 2 is 81, and 3 or more is 95. And then lastly is our purchase price limit. So that is for in your non-target areas for new or existing, 283, 348. And then you'll see if you're buying in a target area, the purchase price limits are higher. But mostly you're looking first-time buyer and or not in the last 3 years, and your non-target limits. There are a couple fees to get into the program. So there's a one-time initial program fee. So if it can be collected at closing, that's great. If you have their seller contributing towards closing costs, any kind of incentive. One time we were working with KV Homes, the builder was paying for the program fee. Otherwise, we can offer a payment plan, especially since they're not claiming this until they start filing taxes next year. So for instance, right now, if you have anybody closing in this year, we can make a 6-month payment plan because they're not going to start claiming the credit until January of next year. And then I put here for SALT. SALT is our sister agency. They have some new construction homes also, and if you're purchasing one of their homes, they are paying for the program fee also. And then there's an annual renewal fee, but technically this isn't going to kick in until they start seeing that $2,000 benefit. We meet with the buyers and we show them this is how you benefit. This is where it would go in your tax returns. But when I talked about earlier, if they go back to school and they're not going to be claiming the credit, then they don't pay that $100 renewal fee. So it's a case by case every year. And then we also actually offer free tax preparation. So, because we definitely want to make sure people are taking advantage of the program, because people are not familiar with the program, even tax preparers, even though it's been around since 1991. It's something we want to make sure people are taking advantage of the program, and we're not going to be having them pay that renewal fee unless they for sure are claiming that credit. Again, here's another example of increasing the buyer's loan eligibility. So this is where your lenders kick in and do a great job at doing it. So in the example here, we showed you how the program works and how the credit is $2,000. But what your mortgage lender can do is they can consider this $2,000 as additional income. So you'll see here that 2,000 divided by 12 is $166 a month. Your lender can add that to the client's loan application to help get them approved. So whether it's if their ratios are off, maybe they have student loans or their car payment's too high, if they plug this in, maybe they now qualify. Or maybe they qualify for $195,000 and they can plug in this extra credit. Now they can shop for a $200,000 house. You know, it increases their buying power. So this is something that, you know, it's also beneficial to your home buyers if for some reason they don't qualify. Maybe your lender can plug this in and say, maybe this is going to work and this is all we need to get them qualified now. And then for your buyers at the very bottom, we put there is, because they're going to be getting this credit, like I showed you on that tax return, their refund is higher. Sometimes we say, okay, if you're having a hard time making your payments, or if the lender uses money to be able to buy more house, maybe they want to take more money home on their paychecks to be more comfortable making their mortgage payment. So we can explain to them, now that you're going to have this $2,000 credit, you're going to not need as much money taken out of your pay stubs. So sometimes we'll tell them, go, you know, to your employer, and the example down here in this $2,000 credit, if you're paid bi-weekly, that's about, you know, almost $80 a paycheck. So sometimes we'll say, talk to your employer, you can go ahead and take home $80 more per paycheck because you're going to have this credit that's going to offset what IRS wants from you. Or if they want to leave it the way it is, it'll just increase their refund. Okay. So that was like a quick explanation. Main thing we're looking for with the tax credit program: first-time buyer or not owned in the last 3 years, income limit, purchase price limits. Right now, the application process is done all via email. Usually we'll meet with the clients, show them on their tax return where they qualify, how it benefits them on their tax return. If they qualify, do the application. Right now, we're just, if they can email us their tax returns, we'll review it over the phone or similar to this via Zoom. And then we also go over the application, and the application does need to be notarized, but if they do the review with me, I can still notarize it for them since it's our form. And we still are been able to run business from home, which is I'm very grateful for, and am not slowed down the process in any way.